I want you to try a little experiment with me. It involves a bit of mental time travel.
Yeah.
I want you to think back to the last time you had to sell a car.
Oh, I'm already getting stressed.
Right. Not the fun part where you get the new one, but that miserable part where you have to get rid of the old one.
Oh, I know this movie. You're talking about the weird Craigslist meetups in a grocery store parking lot at 8 p.m. at night
Hmm.
with some guy who might or might not show up.
Exactly. The weird texts, the constant lowball offers, the guy who wants to pay you in some crypto you've never heard of or trade you a jet ski. It's a
It
nightmare.
is a total nightmare.
But then think about the alternative. You drive to a CarMax or a dealership, you pull in, a guy with a clipboard walks around your car, checks the odometer, maybe kicks a tire, types something into an iPad, and 20 minutes later, bam,
Check in hand, you walk away.
you walk away, it's done.
It is the ultimate exchange of value for convenience. You know you're probably leaving a few hundred, maybe even $1,000 on the table compared to a private sale.
Yeah,
But you don't care.
not at all.
You paid that money to avoid the headache. And in finance, we call that removing friction.
Right, friction. Now, take that exact concept, that instant liquidity that CarMax experienced,
Okay.
and apply it to the single biggest, most terrifyingly expensive, and most illiquid asset you will ever own,
Your house.
your house.
This is the holy grail. I mean, this is what people in fintech and proptech have been dreaming about for decades.
Imagine you get a new job across the country, you don't clean the house, you don't stage it with fake fruit bowls and sad beige furniture, you don't have to, herd your family and your dog out the door every Sunday afternoon for an open house.
Right.
You just push a button on an app. An algorithm somewhere in a server farm in Virginia looks at your house from space, or at least from Google Maps, crunches some numbers, and wires you $500,000. That is the promise.
It's a beautiful promise. It's
Yeah.
the sci-fi future of real estate, where a home is just like a share of Apple stock. It's liquid, it's tradable, it's instant.
But as we know, sci-fi stories usually have a twist, right? There's always a point where the robot turns evil or the spaceship blows up. And today, we're doing a deep dive into the company that tried to build that spaceship. We are talking about Opendoor Technologies.
And this is a story that has absolutely everything. I mean, it has the hubris of Silicon Valley. It has billions and billions of dollars in venture capital. It has a spectacular, truly epic crash.
Oh, yeah.
And now, here in 2026, it has this fascinating, gritty, maybe even surprising attempt at a comeback.
We have a massive stack of research here today. We've got the 10K filings, which are, the official financial reports. We've got the FTC complaints, and we are definitely going to read from those because they are spicy.
They're very spicy.
And we've got the whole history of the iBuyer movement. Our mission today isn't just to look at a tech stock. It's to figure out, can you actually turn a house into a commodity? Or is real estate just too messy, too emotional, and, too physical for an algorithm to truly understand?
And we have to ask the big question that goes with that. When an algorithm buys your house, who is actually taking on the risk? Because, as Opendoor found out the hard way, when you own the asset, you also own the disaster.
So let's rewind. We need to go back to a time when interest rates were basically zero, hope was incredibly high, and disruption was the only word that mattered.
The before times, 2014, San Francisco.
Exactly. The golden age of the unicorn, when every startup was going to change the world.
And get $1 billion valuation for doing it.
Right. So Opendoor is founded in 2014, and the founding team isn't just some random group of college dropouts with a good idea. This was a supergroup, a tech all-star team.
It really was. You had Keith Rabois, Eric Wu, Ian Wong, and J.D. Ross. Now, if you follow tech Twitter or Silicon Valley lore, you know some of these names. Keith Rabois is a heavy hitter. He's part of the original PayPal Mafia, that group that includes Elon Musk, Peter Thiel, Reid Hoffman. He has this very aggressive, very distinct sort of libertarian worldview about how things should work.
And Eric Wu, he was the real estate guy, right?
Eric was the domain expert. He was crucial. He had already built and sold a real estate data startup called Movity to Trulia. So he understood the data side of housing, which was, the secret sauce they were promising.
Okay, so you have the big picture visionary and the industry expert.
And their pitch was simple, but incredibly audacious. They basically said, real estate is the last major asset class in the world that hasn't been truly digitized. You can buy stocks instantly. You can buy crypto instantly. You can buy a car instantly. Why does it still take 90 days, an army of middlemen, and a mountain of paperwork to sell a house?
It's a great question. And the money loved this pitch.
Oh, they couldn't get enough of it. They raised nearly $10 million, $9.95 million to be exact, right out of the gate in a seed round led by Coastal Ventures, which for 2014 was a massive seed round.
I want to pause on the actual mechanism here, though, because iBuyer is a buzzword that gets thrown around, but we need to unpack how it actually works. How is this fundamentally different from, say, Zillow?
This is the most important distinction to understand about this whole story.
Yeah.
And it's where all the risk comes from. Traditionally, a company like Zillow or Redfin, they're marketplaces.
Right.
They're like eBay or a classified ad page. They introduce a buyer to a seller, and they take a little fee, usually ad revenue from agents, or a referral fee for making that introduction. They are what we call asset light.
Zillow doesn't care if my house has termites.
Zillow does not care at all if your house has termites, because Zillow never, ever owns your house. They're just the billboard.
Okay. If I sell my house on Zillow, Zillow never writes me a check. Someone else does.
Exactly. Opendoor is an iBuyer, an instant buyer. They are a market maker, and this is the key. Think of them like the currency exchange booth at the airport. They have a massive pile of cash. You come to their window, you give them your asset, in this case your house, and they give you cash instantly. At that moment, they take the house onto their own balance sheet. They own it.
They own it. So they are paying the taxes. They're paying the insurance, the electricity bill.
They are fixing the leaky faucet. They're mowing the lawn. And then, and this is the business, they try to sell it to someone else for a small profit.
So in plain English, they are house flippers.
They are house flippers, but there's a huge difference in scale. A typical house flipper is, a guy named Dave with a pickup truck who does maybe 2-3 houses a year. Opendoor wanted to be a robot named Dave that flips 50,000 houses a year.
And that scales the risk enormously. I mean, if Dave the flipper buys one bad house in a bad neighborhood, Dave loses money on that one deal.
It's a bad year for Dave.
It's a bad year for Dave. But if Opendoor's algorithm misprices an entire zip code and they buy 10,000 bad houses at once,
then you lose hundreds of millions of dollars in a single quarter. And we saw that happen. The core of their business model was the fee. They charged the seller a service fee, which they argued was roughly the same as the 5 or 6% you'd pay a traditional real estate agent. And then, on top of that, they'd deduct the estimated cost of repairs.
Okay, let's talk about those repairs for a second. Because anyone who has ever owned a home knows that the word repairs is a financial black hole. You think it's a $500 patch on the roof, and suddenly you're replacing the entire decking for $10,000. How does an algorithm looking at photos online know that the basement smells a little bit like mildew when it rains?
It doesn't. And that is a classic economic problem called adverse selection.
Right.
The people most likely to want to sell their house instantly for cash, with no questions asked, are often the people who know their house has issues that would scare away a regular family doing a thorough inspection.
The person with the crack in the foundation that they've cleverly hidden behind a bookshelf.
Exactly that person. Opendoor tried to solve this with video walkthroughs and hiring local inspectors, but you can't code creaky floorboards or that weird neighbor with the loud dog into a spreadsheet very easily.
So they are taking on massive, massive capital risk. But in the late 2010s, risk was in fashion.
Risk was cheap. This is so important. Interest rates were historically low, meaning Opendoor could go to big banks and get credit lines for billions of dollars at very, very low rates to buy these houses. It was almost free money for them.
And speaking of basically free money, enter SoftBank.
The Vision Fund, the ultimate kingmaker of that era. In 2018, Masayoshi Son's SoftBank dropped $400 million into Opendoor. This was the moment the company went from being an interesting startup to, wait, are they going to own every house in America?
A $400 million check.
They have a huge validation. By 2019, they were privately valued at nearly $4 billion. They were a certified unicorn.
And they weren't just content with the buying and selling part of the transaction, right? They wanted the whole pie.
They wanted the full stack. This is a classic Silicon Valley strategy. Uber doesn't just want to be your taxi. They want to deliver your food with Uber Eats and your packages with Uber Freight.
Own the whole customer relationship.
Right. Opendoor acquired a title and escrow company called OS National. Then they launched Opendoor Home Loans. The logic was, if we're already controlling the transaction, why are we letting some bank get the interest payments on the mortgage? Why are we letting a separate title company get the closing fees? We should keep every single dollar associated with this house changing hands.
It makes perfect sense on a whiteboard. It's a closed loop, a flywheel. You buy the house, you provide the loan to the next buyer, you handle the title. More revenue at every step.
It is a beautiful flywheel. Until that flywheel hits a brick wall at 100 miles an hour.
March 2020.
The COVID shock. The day the world stopped turning.
Take us back to that moment inside a company like Opendoor, because for a business that relies entirely on liquidity, on being able to buy and sell houses fast, a global lockdown must have been an absolutely terrifying prospect.
It was an existential cardiac arrest. Think about it. In March 2020, the entire world stopped. Opendoor was sitting on hundreds of millions, if not billions of dollars worth of houses on their balance sheet that nobody was legally allowed to visit. Their liquidity, the ability to turn those houses back into cash, dried up instantly. On March 20th, they suspended all home buying across the country.
Cold turkey. Flip a switch.
Cold turkey. The machine just stopped. We're not buying your house today, sorry. And they also laid off 600 people, which was 35% of their entire staff, in a single Zoom call, effectively. It was brutal. At that specific moment, it looked like the iBuyer experiment and over. It looked like a fatal business model flaw had been exposed.
But then, one of the weirdest things in modern economic history happened. We didn't go into a deep, prolonged housing depression. We went into a housing mania.
The V-shaped recovery. It was completely unexpected. Everyone was stuck in their tiny apartments staring at the same four walls, realizing they hated their roommates, so they desperately needed a home office.
And the government, the Fed, slashed interest rates to zero.
Making money free again. Suddenly, demand for single-family homes with a yard went vertical. It was a buying frenzy.
And Opendoor, to their credit, pivoted fast.
They did. By May 2020, just a couple of months later, they were back in the market, and they had a brand new pitch, which was perfectly timed. It was the contact-free home sale.
Ah, clever.
You don't want strangers breathing in your house during a global pandemic. You don't want to deal with open houses. Sell to us. We'll do the whole thing digitally. It was the perfect product for that very specific, very strange moment in time.
And this incredible turnaround, this recovery, brings us to the next chapter of the story. The SPAC. We need to really unpack this because looking back now from 2026, the SPAC boom of 2020 and 2021, it feels like a collective fever dream.
It was financial hysteria on a scale we haven't seen in a long time. So a SPAC stands for a special purpose acquisition company, and it's basically what it sounds like, a blank check company.
A shell company.
A total shell company. A celebrity investor or a well-known financier raises a bunch of money from the public markets, lists this empty shell company on the stock market that has no business, no product, no employees, nothing but a pile of cash. And they basically say to investors, trust me, I'm going to go find a cool private company to buy with your money.
It's like giving your friend $20 and saying, go into that store and come out with something cool for me.
Exactly. And the celebrity friend in this particular case was Chamath Palihapitiya.
The SPAC king.
He was the king. He was absolutely everywhere at that time. He was on CNBC every day. He was on the All In podcast. He was tweeting incessantly. And he positioned himself as the Warren Buffett for the new generation, for the tech generation. He found Opendoor and he said, this is it. This is the one. This is the Amazon of real estate.
And because it was a SPAC merger, not a traditional IPO, they could play by slightly looser rules when they were selling this story to the public, right?
Yeah. This is a critical point that people miss. In a traditional initial public offering, the SEC is very, very strict about what you can say and what you can predict. You mostly have to talk about your past performance, your historical results.
You can't just make up numbers for the future.
You cannot. But in a SPAC merger, because it's technically a merger and not an IPO, you are allowed to publish forward-looking statements. You can show a chart that goes straight up and to the right for the next 10 years and say, this is what we think we will do.
So they didn't just sell the past, they sold the dream.
They sold the absolute dream. They put out these presentations projecting massive exponential revenue growth. They projected turning profitable in just a few years. And the market, which was hungry for anything tech-related, just ate it up with a spoon.
So the merger's announced in September 2020. It closes in December.
Right. And it starts trading on the stock market under the ticker symbol OPEN. And the valuation just skyrocketed. At its absolute peak in early 2021, Opendoor was valued at roughly $18 billion.
$18 billion. For a company that, let's be honest, we just described as a pawn shop for houses.
That's a harsh way to put it, but financially, it's not an inaccurate description of the risk profile. They are a capital-intensive, low-margin business. But at $18 billion, they were being valued like a pure software company, like Microsoft.
And software companies have, what, 80% margins?
Exactly. When Microsoft sells another copy of Windows, the marginal cost is zero. It's pure profit. When Opendoor sells a house, they first have to pay for the house. Their gross margins are like 5 or 6% on a really good day. It's a completely different business.
But nobody cared about margins in 2021. They just cared about one thing: growth.
Growth at any cost. And Opendoor gave them growth on a scale that is honestly hard to comprehend. In the single year of 2021, they went on a buying spree. They bought nearly 37,000 homes.
37,000 homes. Just try to visualize that for a second. That is a medium-sized American city. That is every single house in a massive suburb. They owned it all.
And this is where the inventory trap was set. They were aggressively buying these tens of thousands of homes at the absolute peak of the market frenzy. They were competing with regular families, sometimes bidding up prices against them because their algorithm was programmed with one simple truth: housing only goes up.
Famous last words, and then the music stopped.
2022. The Federal Reserve, led by Jerome Powell, looks at runaway inflation and says the party is over. They start hiking interest rates faster and more aggressively than they had in 40 years.
So in the blink of an eye, mortgage rates go from a historic low of 3% to over 7%.
And what happens when mortgage rates double? A potential buyer's purchasing power gets cut in half almost overnight. A family that was pre-approved for a $500,000 house in January can now only afford a $350,000 house in July. Demand just vanished.
But Opendoor was still sitting on a balance sheet with 37,000 houses that they had bought at peak 2021 prices.
This is the nightmare scenario. This is the exact reason Zillow had shut down their own iBuying business a year earlier. They saw this coming and got out. Opendoor drove right off the cliff. In the fourth quarter of 2022, the numbers that came out were absolutely horrific.
Lay it on us.
They sold about 7,500 homes in that quarter. And on average, they lost $28,000 on each and every one.
I want to just drill into that number. A $28,000 loss per house. That's not just, oh, we didn't make a profit. That is literally taking a brand new Toyota Camry, parking it in the driveway of every single house you sell, and setting it on fire.
It's an unbelievable amount of value destruction, and it's even worse if you look at the aggregate numbers. For the full year of 2022, Opendoor lost $1.4 billion.
A billion with a B. How does the math even work there? Can you walk me through the life cycle of one of those losing houses?
Sure. It's a painful but simple story. Okay, let's say they bought a house in Phoenix for $500,000 in March of 2022. Their algorithm, looking at past sales, projects they can sell for $540,000 in a couple of months.
A nice 40K profit.
On paper, yeah. But by June, rates have shot up, the market is frozen, and the actual market value of that house has dropped to, say, $460,000.
So they are already down $40,000 just on the asset price. They're underwater.
Deep underwater. But that's not all. They also spent $15,000 fixing the carpets and painting the walls. They also had to pay 3 months of property taxes, insurance, and, this is the crucial part, interest on the massive loan they used to buy the house in the first place.
Ah, the cost of capital, the carrying costs.
Exactly. When the Fed raises rates, Opendoor's own borrowing costs go up too, so they're getting squeezed from both sides. The asset they own is worth less, and it costs them more money every single day to hold it. So they finally give up and they dump the house for $460,000 just to get the cash back and stop the bleeding. But when you add it all up, they're all in for maybe $530,000.
That is a bloodbath on a single transaction. Multiply that by thousands.
And it completely destroys this core argument that our algorithms are smarter than people.
It really does.
The algorithm is only as good as the data you feed it. And it relies on comps, comparable sales. But comps are by definition historical data. They tell you what a house down the street sold for last month. They don't tell you what a nervous buyer is willing to pay today when Jerome Powell just raised interest rates by 75 basis points for the third time. The algorithm was looking in the rearview mirror while the car was driving headfirst into a swamp.
And while all of this financial disaster was unfolding, they were also losing something just as valuable: trust. We have to talk about the FTC. Because this part of the story, for me, really rubs me the wrong way.
The Federal Trade Commission settlement, this was announced on August 1st, 2022, and it was a bombshell.
What exactly were they accused of? What was the charge?
The charge was, in a nutshell, deceptive marketing. The FTC had gone back and analyzed Opendoor's own marketing materials, the charts and graphs and comparisons they showed to potential home sellers to convince them to take their offer.
The sales pitch.
The sales pitch. And Opendoor consistently claimed that by selling to them, you would actually make more net profit than by listing your home on the open market with a traditional agent.
How did they argue that?
They'd say, well, you save on repair costs, you save on aging commissions, you save on staging costs. They made it look like their offer was the financially superior choice.
Was that true?
The FTC said absolutely not. In fact, the FTC's investigation found that for the vast majority of consumers, selling to Opendoor cost them thousands of dollars more than a traditional sale would have. They found that Opendoor was bundling hidden fees into their offers and that their repair estimates were often inflated way above market rates.
So they were telling people, look at all the money you're saving by using us, while simultaneously reaching into their other pocket and taking their wallet.
That is essentially what the FTC concluded. The headline was convenience and savings, but the fine print was, according to the government, exploitation. Opendoor had to settle the case.
For how much?
The settlement was for $62 million.
$62 million. Now, is that a lot of money for a company this size?
Financially. I mean, honestly, it's a drop in the bucket compared to the $1.4 billion they lost in the market that year. It's a rounding error, but reputationally, it's pure poison.
It's devastating.
It confirms every skeptic's worst suspicion that this tech disruption is just a fancier, more sophisticated way to rip you off. It damages the brand in a way that's really hard to repair.
So let's recap where we are at the end of 2022. The stock price has completely collapsed. They've gone from an $18 billion market cap to barely $1 billion. That's a 94% drawdown from the peak. Most companies die here. They go bankrupt. They get sold for parts to a private equity firm.
They absolutely do. This is usually the end of the story. But Opendoor didn't die. And this is the part of the story where we have to give them some credit for, I don't know if it's resilience or just pure stubbornness.
This brings us to Chapter 4, Leadership Roulette and the Pivot.
That's a good name for it. Because things started changing at the top. Eric Wu, the original founder, he stepped down as CEO. Carrie Wheeler, who was the CFO, took over in early 2023. She's a finance pro. Her job, very clearly, was to stop the bleeding.
She was the turnaround specialist.
She was there to slash costs, manage the inventory, and just stabilize the ship before it sank. And she did. She cut the workforce again. Another huge layoff, 22% of the company, in April 2023.
It's just brutal. It seems like every time the algorithm gets the housing market wrong, 500 real human beings lose their jobs.
That is the dark side of this business model. Labor is treated as a variable cost that you can turn on and off like a spigot. When inventory is high and you're buying a lot, you hire people to manage it. The second you stop buying, you fire them. It's an extremely volatile way to run a company for the employees.
So Carrie Wheeler stabilizes the ship through 23 and 24. But then let's jump forward to the really recent news. September 20, 2025, just a few months ago in our timeline. Another massive leadership shakeup.
This was a big one. This was the return of the founder energy, as they say in the Valley.
What does that mean?
It means Keith Rabois. Remember him from the very beginning. The PayPal mafia guy, the aggressive visionary. He comes back to the company as chairman of the board, and they appoint a brand new CEO, a guy named Kaz Nejatian.
And who is Kaz? What's his background?
Kaz was the chief operating officer at Shopify, and he is known for being extremely operationally rigorous, a very no-nonsense kind of executive. He famously canceled all recurring meetings at Shopify to train to increase productivity. He's a wartime general type of leader.
Not a peacetime manager.
Not at all. He's there to execute a turnaround.
And the market loved this news.
Oh, the stock popped 30% on the day of the announcement. Investors looked at this combination of Rabois and Nejatian and said, okay, the defensive era under Carrie Wheeler is over. These guys aren't here to manage a slow decline. They are here to go on offense.
But how can they go on offense? The housing market is still tough. Rates are still relatively high. What's the new strategy? What are they doing differently now?
It seemed to be a mix of renewed aggression and newfound partnership. First, they stopped trying to kill their competitors like Zillow and Redfin. They partnered with them.
So if you can't beat them, join them.
Basically. Now, if you are browsing on Zillow, you can see a button that says, get an instant offer from Opendoor. They became the back-end liquidity provider for the whole real estate internet.
They became frenemies.
Exactly. Better to get a slice of Zillow's pie than no pie at all. Second, and this is a bit counterintuitive, they doubled down on some of the most expensive and high-value markets, like the Bay Area.
Wait, why would they do that? That seems way riskier. A single house in San Francisco costs, what, $1.5 million?
Yeah.
If you get that wrong, the loss is huge.
It is much riskier, but the potential spread, the profit margin, is also much bigger. Think about it. If you charge a 5% fee on a $200,000 house in Cleveland, you make $10,000. That barely covers your operational costs.
Right.
But if you charge that same 5% fee on a $2 million house in Palo Alto, you make $100,000. The paperwork cost is the same. The inspection cost is roughly the same. So the unit economics work much, much better on expensive homes if, and this is the giant if, you don't misprice the house.
A very big if.
A company-defining if.
So that brings us to today, early 2026. Let's look at the scorecard. The 2024 annual report came out a few weeks ago. Give us the financial reality check. Are they healthy? Is this thing working?
Healthy is a very strong word. I would call it stable but fragile. Let's look at the top line first. Revenue was $5.15 billion for 2024. So they are still moving a lot of metal, or wood and drywall in this case.
It's a real business with real volume. But what about profit? Are they making money yet?
No. Net income was negative $392 million.
So they are still losing a ton of money.
They are. But, and this is the bull case for the company, you have to compare that to the $1.4 billion they lost back in 2022. They have successfully reduced their annual losses by about 70%. That is a massive operational improvement. But you cannot lose almost $400 million a year forever. The clock is ticking.
I'm looking at their balance sheet from that report. Total assets, $3.13 billion. Total equity, $713 million. Can you translate that for us, non-CFOs?
Sure. It means they are highly leveraged. Equity is the part of the company that the shareholders actually own, free and clear. The assets include all the homes they bought using borrowed money, using debt. A debt-to-equity ratio of roughly 4-to-1 isn't totally insane for a real estate company, but it leaves very, very little room for error.
What do you mean by that?
It means if the overall value of their assets, the thousands of homes they own, drops by just 20%, their entire equity position is wiped out. They're insolvent, bankrupt.
So they're walking a very high tightrope.
A very high tightrope in a very windy city.
And they are doing it with a much smaller team. The employee count is down to 1,100 people now, down from thousands at the peak.
And that's the tech part of their story finally kicking in. They're trying to automate everything they possibly can, automate the pricing offers, automate the scheduling of contractors, automate the title transfer process. They're trying to remove the expensive human from the loop wherever possible to lower their costs.
One number that really jumped out at me from their recent report was the inventory hold time. They said the average is now 90 days.
That is the killer metric. That is the number that keeps their CEO up at night. 90 days.
Why is that one number so critically important?
Because of the carrying costs we talked about earlier. Let's do some quick back-of-the-napkin math. You buy a house for $500,000. You borrow that money from a bank at, let's say, 6% interest today. That loan alone costs you roughly $82 every single day in just interest payments. Then add property taxes, maybe another $20 a day. Insurance, $5 a day. Utilities to keep the lights on, $10 a day. You are burning over $100, maybe $120 every single morning you wake up and still own that empty house.
So every single day that house sits on the market, the potential profit margin shrinks.
It just melts away like an ice cube on the sidewalk. If you can buy it and sell it in one day, you're a genius. If you sell it in 90 days, you've burned through more than $10,000 just in holding costs before you even account for repairs or fees. If it takes 180 days to sell, you are almost certainly taking a big loss. Speed is the only thing that matters in this business.
And that, I guess, explains why they have to be so much more aggressive with their offers now. They can't afford to be generous with sellers anymore. They have to build in a bigger buffer for themselves.
Right. And that brings us right back to the original value proposition for the consumer. If Opendoor has to offer you less money for your house to protect themselves from market risk, is the convenience factor still worth it?
That is the ultimate question, isn't it? We started this whole deep dive talking about friction. Opendoor's entire premise is that they remove the friction of selling your home. But friction has a price.
In 2021, when money was free and the market was screaming upwards, Opendoor and their venture capital backers subsidized that price. They deliberately overpaid for houses just to gain market share. Now, here in 2026, that subsidy is gone. The consumer, the home seller, has to pay the full, true cost of that convenience.
It's exactly like the Uber model. Remember when you could get an Uber ride across town for $6 because investors were subsidizing it?
Oh, yeah. And now that same ride is $45.
Exactly. The investors stopped paying for part of our rides, and now Opendoor's investors have stopped paying for part of our home sales.
So the question for you, the listener, is, how much is your sanity worth? How much would you pay to avoid those open houses and that uncertainty? Is it worth $20,000? Is it worth $50,000? Because that is the kind of spread Opendoor now needs to survive and eventually thrive.
It's just fascinating because despite the spectacular crash, despite the billions in losses, despite the layoffs, despite the FTC settlement, the core vision hasn't died. The dream of push-button sell house is so powerful and so compelling that Wall Street keeps giving them chance after chance to get it right.
It is the largest undisrupted market in the entire world. U.S. residential real estate is a $30 trillion asset class, trillion with a T. Even if Opendoor only ever sustainably captures 1% of that market, it is a massive, highly profitable company. That is the prize. That is why Keith Rabois came back. That is why SoftBank held on through all the pain. The potential reward is just too big to ignore.
But getting there requires turning a home, a place with memories and quirks and emotional baggage for people, into just another data point on a server.
And it requires building an algorithm that can predict the future of interest rates and market psychology better than the Federal Reserve can, which, as we've seen over the last few years, is a very, very tall order.
I want to wrap up with a final thought for everyone listening to this. We often talk about big tech watching us, our search history, our location data, our shopping habits. But Opendoor represents a completely different kind of digitization. They are digitizing the physical world. They are turning your neighborhood, your block, your cul-de-sac into an Excel spreadsheet of assets to be traded.
And when you do that, you introduce the volatility and the cold, hard math of the stock market into the place where you sleep at night.
So if you are thinking of selling your house in 2026, you now have this very modern choice. You can call a local agent, bake some cookies for the open house, and deal with all that human friction. Or you can log in, get an instant offer from the algorithm, and see what the machine thinks your life is worth.
Just maybe check the fine print this time. And I'd recommend not spending the money until the check fully clears.
Wise words. Thanks for joining us on this deep dive into the rise, the fall, and the truly fascinating reinvention of Opendoor. It's a wild story, and I have a feeling it's not over yet.
Not even close. This is just the beginning.
We'll see you on the next one. Stay curious.